So to jump into it, investment structure strategies. What we're going to be covering here are strategies on how to approach a deal that you might otherwise say no to, but if you could structure it differently, it might align you more, save you money on fees, add momentum, and just help you get the deal done. And through the last 13 years running the Family Office Club, I've built up a 16-person team. I own 100% of the firm. We don't have any debt or big banker brother, big brother type partners on the business that own us or pulling strings behind the scenes or anything. And importantly, we're not just a conference company. We're not consultants. We help people who are raising capital, but also help family offices and private investors. So we help investors by taking a performance fee on deals they invest in through us. And we help them set up and formalize their family offices and be smarter private investors. And we don't charge them anything for the consulting. They only get charged a little profit share participation when they do an investment through us. And on the capital raiser side, we help through our workshops. We have about 150 capital raising strategies you can get from us. We help with our pitchdex.com investor relations marketing agency that works with people on a retainer basis. We have familyofficedatabases.com. And most importantly, we put out more thought leadership than most of our competitors combined through books, YouTube videos, family office podcasts, etc. So if you look at the visual of the webinar here, you can see some of the things that we do for our members. We have 2,000 registered investor members, and we have within that a pod of 81 investors who are highly active that we're under contract showing deals to, and their average net worth is 22 million. And then we have 850 or so registered subscribers and members. What they're getting access to is weekly virtual investor discussion panels. They're getting access to those 130 proven capital raising strategies that are within the recorded workshops. Every single day we record via Zoom. Sometimes we do 3 a day like yesterday, daily investor mandate interviews, and we release one of those every business day. So you get to see a 7-minute interview with an investor and exactly what they're investing in. We have 42 niche specific investor databases. Every quarter we give you feedback and 20 bullet points on your pitch deck and all your materials. We just did that for a 400 million in AUM fund this morning that's looking to join us on the pitchdex.com side. And then we have about 2,000 registered investors inside of our club as kind of leads to network with and meet once our live events start again. So you can check that out at familyoffices.com after this if you like. This is just a screenshot of the different mandates we have. So you can kind of see the types. We have angel investor mandates, single family offices, $1 billion plus family offices, private investor mandates, real estate, technology, etc. We do have the #1 most downloaded podcast. Family Office Podcast is the creative name of that. Familyoffices.com is the most visited website in the industry. And I want to point out that in doing this for 13 years now, I started in 2007, not the best time to start a finance or investment business, but similar to these times, I found that there are some golden threads that tie things together. The people who are raising the most capital are doing a lot in common, and the people who are struggling to raise their first million or they have no idea how to get started, they're doing a lot in common, but there's a huge gap between them. They're not doing anywhere close to the same things. The same thing for investors. If you're listening here as an investor, the people who just became wealthy and they're doing direct investments for the first time, trying to figure out real estate or how to invest in companies, they're doing things very differently than those who have been investing for 7 to 10 years. So how do you make that jump and move up that curve as fast as possible? That's what the Family Office Club is all about. If you're part of our community, within 18 months, we're going to transform your deal flow, how you look at deals, how you structure deals, how you talk to investors, how you position yourself. And we're just going to help you be more effective for every hour of energy and every $100,000 that you invest in something. If you're an investor, we're going to help you get more juice out of that time and that money invested. So some things I like to always look for are commonalities among who's doing the best and who's doing the worst. I also like to look for what are the common mistakes, the most painful mistakes that could easily be avoided if they just were pointed them out to you. And also, I like the Dan Kennedy phrase, if you're not sure what to do, just do the opposite of what everyone else is doing, and it's probably going to work better. And so you'll see a theme of that throughout today here on the webinar. So here are the 12 different structures we're going to go through. We're going to talk about first why it's important, then we're going to talk about equity investments, convertible notes, venture debt, gross revenue royalties, LLC partnerships, traditional LP-GP structures, fake skin in the game, performance fee only structures, co-GP structures, preferred income structures, and minimum investment levels. We'll talk about a few others in between that are related to these, but these are going to be the main things that we're going to be covering here today. on the webinar. So first of all, why should we talk about structures at all? I think it's pretty obvious. You wouldn't be here unless you knew why you wanted to learn about it. And it's been one of our most popular webinars yet, despite telling everyone they missed it. We've got 900 people live on here now. But the reason why I would go and talk about structures is that if you can create more alignment, it's good for everybody. It's good for the person who's running the deal. It's good for the investor. And then they're going to talk about it more because they feel that alignment. And it's going to be refreshing because they're going to feel like you have their best interest in mind. And you should genuinely always have that best interest in mind, of course. It's not just a feeling. But also you might be able to lower the total amount of fees they're paying or add more value or address what's the specific risk for them. If you're raising capital only from angel investors or only from surgeons or only from billion-dollar-plus family offices, they're going to see risk differently. And the person worth $7 million might really like a income investment. And they'd rather have it structured as a 10% income investment rather than an equity investment. And maybe it gives you more equity if you're the one raising the capital. At the end of the day, you might leave with more equity in your own deal if you do structure it as debt, as long as your deal can be healthy enough to pay that debt note or preferred income note. It also will add to momentum if you have good structures on the investment side and the investor side. So it doesn't matter if you're raising capital or looking for great deals, you can come at the deal and say, well, instead of that deal, why don't we just structure this as a royalty? Then that can help smooth things out and help the relationship move forward. A good example of that is a group which came to our New York family office event, and they had never heard about family offices before. They learned about them through the Family Office Club. They then have gone in the last 4 or 5 years to 250 million in assets through just 3 investors. And they credit all their knowledge or a lot of their knowledge to Family Office Club. And that's not typical. A lot of people start out as private investors and slowly ratchet up to higher quality or higher size investors, I should say. And if you don't have the right structures, you're not going to be able to make that jump or go towards the family office space as easily, at least. All right, so first structure, equity investments. The most simple ones I'm going to glaze over super fast because I know that 60% of you would just be bored to death if I talked about equity investment structures for 30 minutes. So this is something where somebody says, do you want to invest $100,000 for 10% equity in my company? You know, you're effectively evaluating the company at $1 million. As simple as that sounds, we have people who sometimes don't get that when they're pitching deals, even though it's the most basic structure there is. The problem with this structure is a fair valuation. How do you value a company that says that they have projections to do 20 million in revenue and they did $200,000 last year, which is what I just saw in a projection last week. Just like Daymond John on Shark Tank recently, he said like, well, I project I'm going to look like the guy Thor from the movies next year by going to the gym. I can project whatever I want. It doesn't mean anything. And no one ever projects that things are going to go badly. So the projections are somewhat worthless to a lot of investors. So the valuation issue really keeps a lot of equity investments from ever getting done. And that's why this webinar is needed to go into these more innovative structures. The next strategy we're going to talk about is convertible notes. This is a very common structure to use, but I don't think is a very good one. Many times there is a convertible note where someone might get paid a 7 or 8% debt note or preferred return. And then when the next round gets raised, which might be conceivably 9 months later to 18 months later, usually 9 to 12 months later, then they get a 25% discount at whatever they raise that next round at. But many times convertible notes are used when it's very hard to value a company because they don't have much momentum yet. And what happens is that non-sophisticated investors, or if it's just a really great company, will go into this. But I feel like the companies who do the convertible notes many times are getting a great deal by doing it, because if there was a fair way to value the deal, what's the value when a company has no capital, no product, no revenue yet, and someone's putting their money at risk versus a year later, once they have some revenue, they have more clients, they've done a capital raise, they've shown they can do that and manage the money wisely. In my mind, the company should be worth, 50% or 2 times more later. And usually you're just getting a 25% discount on that next round. So I don't think it's the best deal for the investor, but it's very commonly used. More people do convertible notes on early stage than just a straight equity investment. And I think that's important to note. Venture debt is another way to structure deals. It's simply doing a debt note where someone can't get normal financing, they can't get SBA, they can't get normal bank financing because of collateral issues. And maybe a bank financing might be at the 6 to 8%. Well, they might come in at 9% to 12%. is a typical range I see, and they might take a 1 to 10% equity kicker or an equity warrant on the back end. And so that's something that I think is going to be increasingly common going forward. I see some family offices using this strategy, but not a lot right now. And I just think it's something worth mentioning in case you're struggling to get a deal figured out and you do have some revenue, then this is something to consider because it can preserve your equity, saying like, well, why don't I give you a 12% return on your money? You think, I'm not going to fail. I might struggle. I might bump along. I might go down before I go up. But if you really do believe in our business and you've seen the revenue coming in, why don't we give you a 12% note instead of 15% equity? And we're going to give you 3% equity and a 12% note. And we'll come to you first on our next round of investment. And we'll figure out fair terms for that investment as well. And that can be a way to get through some of these negotiations. All right, the next strategy we're going to talk about, I want to go into a little bit more depth on to make sure that we make it easy to understand. I've done 5 gross revenue royalty deals to date. And so the first one I did was with an organic women's skincare company, and I negotiated a bit too well. I got too much of a gross revenue royalty and bought a third of the business. We tripled the revenues in 6 months, and then I sold my shares. But we had to lower the revenue, the gross revenue royalty I had negotiated. And recently with one of our PitchText.com clients, they were struggling to negotiate a deal, and I told them to negotiate a royalty. And they said, oh, great, well, we'll ask for a 10% gross revenue royalty. And I said, well, you might bleed the company dry and there'll be no cash to run off of. So I would suggest, a 1 to 7% or 1 to 5%. And after pitching it to the company, even though the company agreed, they came back to them and renegotiated that down just after looking at the math together. They realized it wasn't too practical. So the amount of the gross revenue royalty is important. But let me give you a very clear example of how this can be super helpful. And then I'll give you an example on the real estate side as well, which I think people don't think of often when it comes to gross revenue royalties. So there's a company called Better Bath, Better Body. I've known the CEO, Jason, for quite a while. They're an Amazon-based, all-natural bath salt company. And they were going to raise capital, and they were doing over $100,000 a month in revenue. And I looked to be their first investor. And I said, well, I've done this other organic skincare investment. How about I come into this as a gross revenue royalty, and we'll structure it at, say, a 3% gross revenue royalty. Actually, this one was 1.5% on the first investment, 1.5%. And I was getting paid 1.2 times my money. So I put in $100,000, I get 1.2 times, $120,000 back. At that point, my equity warrant went down from 1.5% to 1% because I'd gotten my money off the table plus a 20% return over an expected 3-year period. And I'm on track to get it back in maybe 2 years and 4 months in this case. And so that deal could get done because otherwise the founder thinks, okay, they think maybe their company's worth 1.5 million. Well, if they're doing 100,000 a month in revenue, they're doing 1.2 million a year in revenue, then that means maybe their profits, would potentially be, at 150,000, 170,000 for the year. And even a 5 times profits only gets them to 600,000-700,000 in valuation if you're doing a 3 times profits valuation. So it'd have to be kind of a rich valuation to meet what he wanted. That's exactly when you could use a gross revenue royalty. Because in this case, if I would have invested at the high valuation, then I would not have been happy. I would have felt like I was overpaying. And by structuring it as a royalty, I was able to get money off the table every month. In a consumer products company, many times they reinvest the revenue and the profits and they don't pay out any dividends for maybe 5-10 years until they have an exit. In this case, the very next month, I was getting a wire transfer back. And then I structured it as an equity warrant instead of equity. So if they raise additional rounds, I don't get diluted. My warrant doesn't expire and it gets activated at the exit so that I can participate in the exit of the deal down the road. So after I get 1.2 times my money back, I get a smaller royalty in perpetuity. So I'll be like an advisory board member and be motivated to still help them grow, and then also be motivated by that equity on the back end. And so what I did for this next round with Better Bath, Better Body, I invested with one of my clients. I took half the deal. They took half the deal for 150 each. We both went in, negotiated a gross revenue royalty, and now same 1.2 times terms. And then now I have a larger equity warrant in the company that's getting reduced from X% to Y% once I get that total 1.2 times back on that second round of investment. So the point here is that many companies think that they're going to blow out the lights and grow astronomically. Many companies do well, and they do meet some of their projections, but it doesn't always go as rosy as they plan. And so this helps you get around valuation issues. If someone says, hey, I'm worth $5 million, and let's say they're doing $500,000 in revenue or $1 million in revenue, you might be able to say, well, I don't think you're worth $5 million. I think that's pretty rich, but if we structure it as a royalty, then I'll be able to get my gross revenue off the top, maybe 2% of your gross revenues. And then once I get that return back, then my equity warrant can shrink or equity can shrink. I always recommend doing an equity warrant, most of the time considering that, so you can't get diluted multiple times over if you can negotiate that, and it helps you get the deal done. We had one client came to us and said, well, how do I use this to my benefit as somebody who's raising capital? Because I value my equity very high. And I said, well, the best thing to do would be to structure the deal where instead of giving away a lot of equity on the back, you give them a great return on their gross revenue royalty. So then you say, okay, well, let's have a 2% gross revenue royalty, but I'll give you 2 times your money back. And then your equity warrant is going from 5% to 1%, but you already doubled your money. So just a little 1% rider for in case we sell, or you can help us get to a sale at some point. You can be an advisory board member. That would be a way to preserve equity if you're a business owner trying to use gross revenue royalties. The other thing is if an investor says, well, I want my money back quickly because I think you're doing well now, but this is a little bit of a scary market for me, then you could say, okay, well, let's structure it so you get a 4% gross revenue royalty, but you're just getting 1 times your money back or 1.1 times your money back because you're going to get paid back in 1 year. It's a 10% return if everything goes as planned, and it's a short-term investment for you. And then you negotiate whatever the equity or equity warrant should be. So I want to stop for 1 second to see if there's any royalty questions. This is something we've gotten a lot of questions on before, and we get questions on at our event quite a bit. If you have a question on this, feel free to submit it. Can you explain pricing terms of the warrant obtained in conjunction with the gross revenue royalty? Yes, so basically the pricing that we negotiated was a warrant that gets activated at the exit, for $1. So there's some amount that's purchasing that warrant and activating it. I'm not a lawyer, I'm not a compliance expert, I'm not a regulatory expert. So before you draft any legal agreement, you should consult with a few professionals to make sure that the first one you go to knew what they were talking about, of course. But that's how we structured it. Many people have said, well, why wouldn't that expire? Or why would they do that? But if they have a strategic reason to go to you, that's what we teach at our private investor workshops, is that a lot of people will not see deals because they're going to go to the most strategic investor first. And if you can position yourself as an investor who's very strategic and add a lot of value and help grow a company, then they're going to want to do business with you, even at a lower valuation or on different terms. They'll be more flexible on the terms. And there's a way to balance this all out. Someone might say, well, you're stealing the whole shop having that equity warrant. Well, then we can go higher on the valuation or lower on the gross revenue royalty. So there's ways to work that all out when you're working with somebody. There's a question about sending the presentation material. Yes, we're recording this, and we're also going to be sending out the recording and the slides within the thank you email. All right, I'll keep on moving. Oh, before I keep on moving, actually, I just want to point out that my most recent warranty deal or royalty deal was the 5th one that we've closed. And on this one, we did a board, it's like an advisory board member position with a company because they wanted me to take an unknown percentage of carry on deals they closed that they hadn't already had in progress. And I said, well, it's kind of an unknown percentage. I'm giving you my time. That's a known, and it's my most scarce resource. So I'm not really sure how comfortable I am with that. And they said, well, what if we paid you a minimum amount per year as kind of a retainer? And I said, yeah, maybe. And then we thought it over, and I told them about how I've structured some other deals. And they actually really like the gross revenue royalty deal. So for that advisory board position, they're at 100 million plus already, and they're credible. And I've gotten to know them over time and seen what they're doing, and they're unique. And we can be strategically helpful to them as an advisor. And so we have it's around a 2% gross revenue royalty, and it's on the carry and the fees earned off of their future projects. I think they're going to grow to be $1 billion manager. And I didn't even know it'd be possible to use a gross revenue royalty in the real estate space. Of course it is. I don't know why I thought that. I'd always just thought about this as a consumer product, operating business type investment opportunity. I would just warn not to do it with companies that are doing less than $250,000 or $500,000 in revenue. It could be rough, or just be careful on that percentage being low enough on the gross revenue royalty. You just don't kill the growth of the company, of course. So I hope some of you got value from that and ways to use it within your portfolios. All right, this next slide is on LLC partnerships. So there's some real estate firms and private equity companies that will just do straight JVs with their investors. And they'll say, let's go out and buy this asset. We'll create an LLC. We'll help be one of the managing partners of that LLC. We'll have rights to write checks up to a certain amount and act on your behalf, but only under the terms and the operating agreement and articles of incorporation that are included on that LLC. And by doing that, you're trying to show them that you're highly aligned and that you're in it together, and that if needed, there could be some clause in there where they get kicked out. If they're breaking some rules, if they're not being transparent, if they're not doing what's promised, then they're kicked out, and the investor already has an LLC in place. They already own the asset. This is usually done on larger one-off deals, or someone who systematically has just found this is the most aligned way to work with their investors overall. I know one group that's raised over $100 million, they do this with all of their investors. They've formed a couple hundred LLCs doing this along the way with their investors, and they found it worked well. But it's a unique approach that I don't see too many using. It could expose the investor to liability that they might not want. And you'd have to seek legal counsel on that, but it could just make them, for the more sophisticated investor, they might feel more exposed, but also for the more sophisticated, they might like that optionality for full control in kicking out the manager if things go poorly. So it's something to consider, just to know that it's out there and that some people are structuring their deals that way. The next one I want to share here is traditional LP-GP structures and hurdles. So some people don't know what GP-LP means. It's general partner, limited partner. Typically, when someone puts together an investment deal, it could be to invest in a private equity company, or it could be a piece of real estate. Typically, they would be the GP. Many times they put up 10% of the equity needed for that deal themselves from their own balance sheet or their co-investors that are kind of part of their inner circle. And then they're raising 90% of the equity needed from what are called LP investors, which are passive investors who are not running the deal typically. Usually, the LP investor has their risk limited to the amount they invested in that deal as an LP, but that's not always the case. So again, always check with the compliance and rules on that. But typically, while the GP typically puts up 10%, many times they put up 0%, 2%, 5%. Some want to really show their confidence in a deal and they have a lot of skin in the game. And they'll put up 15, 20, 33, 50%. Almost no one who has scaled to several hundred million in AUM puts up 50% in every deal. If they do, they've got co-GPs behind the scenes, and we'll talk about that. By far, the most common is 10%. So if you can do 15, it's going to look like you have more skin in the game than others, but you might run out of dry powder to do that. So everyone's constrained by their actual balance sheet, of course, and moving forward with that. I do want to point out that many times there are preferred returns for investors who come in to an LP-GP deal. So they might get a 7 or 8% preferred return. And then after that, there'd be a profit split between the GP and LP. Usually the LP might get something in the range of 75% of the profits after that 7 or 8% preferred return, while the GP keeps 25%. But I've seen as much as, usually as low as it goes is 15 to 20% of the profits is what GPs are taking. Some take 10%, but I really don't see that often. And then I've seen it as high as 50-50. So some people, I've heard one person, his exact words were, we do a 6% preferred return, and then we take 50% of profits on the back end, 5-0. And his exact words were, and that's industry standard. And I thought to myself, wow, I've never heard of anyone taking more than 40% with just a 6% preferred return. But it depends on the deal. It depends on the skill set. It depends on your track record. It depends on your leverage. It depends on the level of sophistication of investors you're going after. It depends on just the value and uniqueness of your deal. So if you have an amazing deal, an amazing track record, an amazing team, maybe you can get away with a 50-50 profit split with no preferred return, but it's not normal. And the other thing I always like to point out is that some people come to me and they're just starting out, and they're doing deal number 4, number 6, and they say, oh, well, I want to charge industry standard fees. And I have to point out to them, well, you're not industry standard. You're a startup with no address on your pitch deck, so I assume you don't have an office. It's okay, you're a small team, and just be honest and transparent with where you're at. But you also have to wear that risk on the sleeve in your materials and your structures so that you're making this less risky in multiple ways for the investor, who otherwise doesn't know if you have a true sustainable operation. So I think that's really important to point out. And I wouldn't go for industry standard. Why would that ever be the goal? You don't want industry standard deal flow. You don't want industry standard brand and positioning. You don't want industry standard positioning strategies for raising capital. And same with investors. You should figure out the most aligned strategy that fits your goals and objectives and mission. And if you've been digesting a lot of our content, you know I'm really big on, before spending any money or any time on anything as an investor, you should know your values, your objectives, the new reality you want to live in, what direction you're heading in. Otherwise, you have no idea if the deal in front of you is a good deal or the right deal or the wrong structure, etc. So hope that makes sense to a lot of the investors listening, but also the investment firms. We get a lot of questions about what the common fees are from people in the industry. So I want to make sure and address that. I'll stop for just 1 or 2 minutes in case anyone has a question related to GP/LP fees. We do have a comment on the royalty model in London. I believe this model is not in massive use. I don't think it's in massive use anywhere. I mentioned this at 4 of our investor summits, and one time I had a family from Norway come up and said they did all their deals through gross revenue royalties. I've never heard of another family office using them a lot. How would other investors feel if the founder used gross revenue royalties? Well, other investors, it depends on how the deal is structured, right? The founder could do a very well-structured deal that's great for the company, or he could give away the farm and it could drain the company of cash. So it depends on the specifics of the deals. With any of these structures, there's good numbers and bad numbers that you can push through them. See if there's another question here. Some tax incentive questions. Not going to be able to go into that here right now. We'll see if we have time at the end. Let's see if they take one more quick question here. What's your thought on acquisition fee and management fee? We're going to get to that in a minute, but lots of fees, not really loved by investors. Lots of fees up front before you've done anything for them. All you've done is tie up their money, and until you return something, it's an opportunity cost. They could have put it in something else. They returned a little bit right away, probably. So the more you can back in the fees, the more aligned you are with the investor, the more that you get paid handsomely when you do very well by them, then the better, I think. And the more that you just nickel and dime them on 18 types of fees, the more they're just going to be repelled. And many times I've seen people look at fee schedules and say, well, these fees are ridiculous. Why would we ever invest in something with so much fees? And then sometimes the response is, oh, well, these are our retail fees, or, oh, well, we're open to negotiation. But so many investors are never even going to give you that feedback. They'll scan the one pager in their busy day and then just archive your email instantly. Like, forget it. Especially if your one-liner, your description of your firm sounds somewhat average and like they've seen it a lot before, and they look at the fees and those look worse than average. I think you're just dead in the water. And just like having a really strong position or brand, you just want it sweating for you and working for you and helping people lean forward to get into your deal. All right, so that brings me to fake skin in the game. So skin in the game means that you have money on the line, you get hurt. If investors get hurt, you do well. If investors do well, that means you're really in the game. Like they say, the hen contributed to breakfast, but the pig is committed, right? The pig turned into the bacon. So they want to know that you've got bacon in the game. And so the problem is that a lot of people, maybe without thinking this through, but I think a lot of them do, and they try to slip it past investors, and then investors get very upset by it, is that they'll say, oh yeah, well, we're putting up 10% of the equity in this deal. And let's say it's a private equity deal for $10 million, and they're getting 75% debt on the deal. So 2.5 million of equity would be needed to get the deal done, 7.5 million of debt. Out of that 2.5 million, if the GP is putting up 10%, that would be 250,000. That means they need to raise the other 2.25 million from investors, and they could go to the investors and say, hey, we have skin in the game. Look, we're putting up 10% of it. But if the investors look into the fees and they see, oh, well, you have a 1% acquisition fee, and that's on the overall deal of 10 million, so there's $100,000, and you have a financing fee of 1%, and your costs there are probably not nearly that, and then you have a management fee of 2%, well, there's another 200,000 that you're getting in the deal. So even if that management fee is paid out quarterly, that means 6 months into the deal, you effectively have no skin in the game, or worst case, by 9 months or a year into the deal, you have negative skin in the game, and now you're just making money off the investors, whether they made money or not. Investors really don't like that. And I know that some people listening to this can't take away all of their acquisition and management fees. They wouldn't be able to survive or keep the lights on or pay their team. But the more you can make fees back-ended, the more it feels aligned to the investor, but it also shows that you're well capitalized, that you're well established. If you had to charge them a whole bunch up front, what does it say about the stability of your organization if, say, a virus crisis, came and knocked on your door? And so I think that investors do feel more comfortable with people that wear that confidence on the sleeve and figure out how to make it through without having those high upfront fees. Which brings me to the next strategy, which is performance-only fee structures. A lot of people balk at this and say, wow, that's ridiculous. We have all of this overhead to cover, especially at a time like we're recording this during the virus crisis, which all of you know, if you're on here live, that people will listen to this maybe over the next 5 or 10 years here. And so overhead is that much more front and center in people's minds. But as I mentioned before, I think that raising capital, working with investors is a momentum game. And if you're an investor, it's a leverage game. People want you to invest in their deals to the point where they'll restructure investments, and you can just find the ones who are amenable to restructuring their investments to fit your ideal structure. So whether that is to focus everything on income or to focus everything on performance fees and say, well, I get that you don't normally do performance fee only, but what if we commit $700,000? Will you do performance fee only and then track your due diligence expenses, and we'll just pay our prorated share of your due diligence expenses? And some people who think this strategy is impossible, one way to get through it is to have a pari passu model where you literally track what it cost you to get that deal underwritten, financed, et cetera. And if your total costs were $119,000 for the travel and everything else, the background checks, et cetera, and that $119,000 then gets charged back and dispersed across to your investors based on the percentage they invested, then that's just a small fee that they're getting attributed to versus taking a management fee that might also cover many other things. So that's kind of a middle of the road approach that you can potentially take on the performance fee model. The most important thing I wanted to stress here was that I've never seen someone do this next version of performance fees, and I don't know why. I think in the future, many people will do it because it's aligned with investors, is basically saying, we're going to charge a performance fee only, but then investors might think, oh, well, we're afraid that you're just going to spike the risk, because even if you have a little bit of skin on the game, it's mostly our skin. And if you lose our money, you lose a little bit, but if you win really big. So you might just take massive risk with this and gamble with our money. And, when I got registered for my wealth advisory practice, they made it very clear, like, oh, performance fees, you have to be careful because it can abuse, clients' risk levels, and you have to communicate that risk to the client, et cetera. And it's interesting that paying someone when they make you money would be a alignment issue. And that regulators are afraid of that, but they're afraid of it because of someone taking obscene risk. It's interesting to me that there's not more of a concern of somebody charging somebody a flat 1% to manage their assets and they don't get paid any less when they lose their money, or when they miss benchmarks and they do horrible for them and they're ignoring the portfolio. I think that's also somewhat of a misalignment, of course. And so the idea here is that if you had a performance fee where the performance fee is generated, maybe 50% or 25% get paid out when they get generated, but then the rest maybe get paid out and dripped out over 4 quarters, 8 quarters, 16 quarters, depending on what industry you're in, what type of investments you're doing with the client. Let's say they invest in 4 different deals with you. Well, then the performance fees, maybe a percentage come out right away, and the rest drips out over a year or 2 or 3 years, so that if you take big risks, that's going to catch up with you. And at some point, you're going to lose money with that investor perhaps, and then the performance fee can be drawn down based on what was lost. So it's a true medium-term performance fee, not just a short-term, spike the return and take that performance fee off the table and run, and maybe the investor will lose, but you've already taken performance fees off of a few past deals from them, so too bad for them. I don't know why in a world where we can do convertible arbitrage notes and sophisticated swaps, et cetera, that there's not more people with, escrow drip performance fee only models. And my prediction is there's going to be a lot more of those in the future. I think it's coming. Oops. So co-GP structures, like I mentioned at the beginning of this webinar, every single day we're interviewing 1 to 3 investors. We're publishing 1 investor mandate interview every single business day to our portal at familyoffices.com. That's one of the benefits of being a member. With the 2,000 registered investors, we've recorded 450 investor mandates and uploaded that. We're getting close to 500 now, actually. And then every week we're doing these virtual investor discussion panels, and every day these mandate interviews. And a few of these mandate interviews, like Erwin here on the screen, if you're watching, it doesn't have his name under there, but where it says 1325 was the length of his interview, or Doc Barat here, who has 9 minutes and 1 second on the visual picture there. They're both looking for co-GP deals. They're both $100 million plus families looking for co-GP opportunities. And we're finding more and more that sophisticated investors want to seek these out. So what are they? It's basically, when I'm talking about a GP, LP traditional structure, the difference here is someone might say, well, I want to put up 25% in every deal to show our confidence, but my balance sheet is running dry with the number of deals we're doing, so I don't have the money to put up. They might go to groups like this and say, hey, if you'll put up an extra 15% on top of my 10%, then I'll give you these financials in the deal. Or they might go to them and say, hey, I can't even put up the 10% anymore. If I just put up 2% of the 10% and you put up 8% of it, I'll give you 25% of my carry on the back end of this deal, or I'll give you X, Y, and Z. Other times they might say, hey, let's both put in half of that 10%, 5 and 5, and then you raise half the LPs, I'll raise half the LPs, we'll source deals together, we'll work it out that way. There's 50 different ways that you could structure that to manage different trade-offs. But if you're listening to this as an investor, there's a few important things to keep in mind. One is that if you want a more sophisticated co-GP structure, it will enhance your returns if you do it correctly more often than not, because you're going to either not pay fees or actually earn fees on your investment versus paying them. But many people you should not do a co-GP structure with, most likely, because they're starting out, they're just ramping up their business, they're not established enough, might not be able to trust them enough. Also, those who are at 600-700 million or $1 billion plus in assets, unless you're bringing $30-50 million checks to the table, then you're not going to have the leverage to get their interest. They're going to say, nope, just become an LP. We've got many people that write us $10 million checks. You can do an LP, we can negotiate on fees, but we don't need a co-GP. We've got too much momentum in the game right now. And so the only people that are most proper to do a co-GP with would be someone at 20, 30, 50 million in assets or 100 million in assets that you really believe in, especially if they're under 100 million, if they have really high conviction. And then ones who are under the 600-700 million or who are having a hard time raising capital, maybe during a crisis time like this. I just want to make sure I mention that, because it's not as easy as just knowing about the structure and then going out and negotiating it. Many people will turn you down. They won't know how to structure it. I have one client who's structuring a $15 million co-investment deal right now. And I've been working with them for 7 months to make progress on that deal. We have term sheets out with 2 other groups on the co-GP type structures, but this one deal at 15 million, I think is going to be the first one most likely to go through. But it's been 7 months of talking to 42 different firms and coming down to these 3 term sheets. And we're always keeping an eye out for other groups as well for our clients. And I'll get to that in 1 second. But on the co-GP deal structure, if you're looking at it from the manager point of view, why would I ever do this? It's because your balance sheet is going dry. You can't put up the 10%, or you need help raising capital. So you want to bring in a big brother partner that could bring some of that GP capital and the LP capital, or someone might bring you an amazing deal. And how do you reward them for that deal? Maybe they could be co-GP on that specific deal, not in your company overall, but on that specific private equity deal or whatever deal you're negotiating. Those are all different options. So we might one day have a whole webinar just on royalties, a whole webinar just on co-GP structures. I can see we have some questions, some hands being raised on this, but we just have 5 more minutes and we're going to go right into this full Q&A for a bit here. But I think we could follow up and go deeper on this. I think it's a big trend to come. And I didn't explain too well at the beginning. With the 2,000 registered investors, 81 of those are highly active investors who have registered with us through privateequity.com, which is not a portal for anyone raising capital. So if you're syndicating deals or looking for other families to invest with you, it's not the place to go. It's only for investors looking for the best deal flow that we're seeing in our family office club, because we interact with 50,000 professionals a year, and 6,000 are usually coming to our live events. And so our 16-person team is always looking out for the best of the best things that match our investor mandates for those 81 investors. So if you want to become investor number 82, you can go to privateequity.com and we can help you navigate a structure like co-GP. Otherwise, if you're on the capital raising side, the Q&A here, follow-up emails to help with any questions you have would be the next proper step. All right, the next thing I want to cover here is preferred income model or a debt model. I think debt is way underused right now in the industry. Everyone is doing these traditional GP, LP deal structures, but investors like income. They like hard assets behind their income. So figuring out the equation can be the biggest challenge. What percentage can you afford to pay out? What are the terms of that? Do you pay out monthly? Do you pay out quarterly? But for investment managers, this can be risky in case you can't meet the debt agreements. They might be able to confiscate an asset after a curing period, perhaps, which might make the interest rate increase during that period and even afterwards. But it could be risky in that way, but it also could be the fastest way to grow your net worth potentially, because I know a few people that have become centimillionaires, become worth over 100 million plus net worth because they are able to find assets that cash flowed at 7, 8, 12, 15%, or companies that kicked off 15% plus in profits, and then go to investors and acquire that asset using investor capital and some of their own, and maybe some traditional debt. And maybe they're paying out the investors at 9% and a 5-year, 7-year note. And the shorter the note, the easier it is to get the deal done with investors, of course, usually. And then by having that note there in place, let's say then after 5 years, the profits from the company pay off the monthly debt payments on that note, then the investor goes away, their note's been paid off. Well, now you own the company free and clear, except for any bank debt that you might have on it, which you could also start paying down more aggressively then. So if you can figure out the use of this model at the right time during your career and evolution of your firm, it could be helpful. I've seen others not structure it as a technical debt note, because if a bank has a lending instrument against your asset, private equity or real estate, then you may not be allowed to, under the docs or sub-docs, be able to also put other debts or liens against that asset, but you might be able to give them essentially the same thing through a preferred income structure. So what that means is that they might get a 9% preferred income off of the cash flow coming off of that investment, or maybe you could structure it a little bit higher, but it's not technically a debt note. It makes it so there's less collateral in place for the investors. You have to be careful with that. You have to really trust the organization. And with that type of situation, the shorter the duration, the easier it will be to pull that off. But I do think that the debt notes could be something that a lot more people in our space could be using. And there's a big thirst for those in the industry. Even if this virus thing lifts off in June, July, and we're living halfway normal lives, besides not being able to go to sporting events or huge conferences with 20,000 people or something, people might still be unsteady about it coming back in the fall, or about what happens if a Democrat gets elected. Some will like that, some business people will be scared to death of that. So I think that income with good quality collateral is almost always in high demand, and it's especially going to be in the short term, visibility that I have on what's going on in the market. All right, the last idea here is just the minimum investment amount. I had a discussion with this with one of our clients yesterday, and it's related to what it takes to get to know you. All of investing is about trust and high conviction, and understanding how value is being added, and really knowing the principles, knowing they're going to do right by you at every turn. That sums up a lot of the whole investment world. And so when people go from raising private investor capital, and now they're trying to come to the family office world, many of them say, oh, well, we want $1 million minimum now. And they were raising $50,000 to $200,000 checks, most of them at $100,000 or less. And then all of a sudden they say, well, we want $1 million minimum now. We don't want to waste our time anymore. We're going to the family office world. But I think it's a big mistake. They've shown, we have a full day workshop. One of our 5 workshops on investor relations is investor influence, and it's how to be more persuasive and influence and persuasion best practices and how to position more effectively. And they've shown scientifically, they've proven that when somebody places a bet on a horse, even for $1, they're more confident that that horse is going to win the race immediately after they place that bet than they were just a few minutes before. So I really think that psychologically it helps you. It also works if you lower your minimum to say $25,000 or $50,000 or $75,000, and people are considering 4 different investments and they're all pretty good, and you're in the top 2, but if someone else has a $25,000 minimum to test them out and really get to know the team, you might lose out. I know a group that manages over 400 million, and they have a $25,000 minimum, and they said everyone thinks they're crazy, but they're raising 100 million a year, so that's fine. They don't care that other people think they're crazy. And they have, their largest investor has 150 million with them. And I know they're negotiating a $10 million investment with an investor right now. So just because your minimum is 25,000 doesn't mean that people can't invest more, of course. If you're doing one deal a year, then that model might not work for you. If you're limited by number of investors for multiple reasons, then that model might not work for you. But for many investors who are doing 4 to 6 deals a year or more, especially, letting them come in, it's almost like an extension of their due diligence to invest $25,000. Most investors are not losing sleep over that. They should always do their full due diligence, but it's almost like an extension of it, so that they get to know how you report to them, how it goes, how you let them participate after the deal is closed, how you report to them every week or month with financials and how the deal is going, and how well you tax structure the deal so that there's, you know, good tax incentives for them coming into the deal. The other one that I don't have a slide for, I wanted to make sure and mention though, was an equity bump structure where, you know, I don't know what sophisticated name, you know, equity bump doesn't sound like the most sophisticated professional name to call it, but for lack of a better name, a structure where the GP comes into a deal, puts up 10%, then before syndicating to other investors, they give themselves a boost and they raise the valuation of the whole deal by 3 or 5 or 6%, and then syndicate it to other investors and charge no other fees. I've only known one firm to do this, and they've grown from 400 million to 2 billion in assets in the last 4 years. I've met with them in person 20 times. I've met their team. One of my investors just went and visited some of their assets in the Midwest and allocated just under $500,000 to that. That's one of my centimillionaire advisors, privateequity.com type investors. And I just find that when you see something that's working really well and nobody is doing it, then that's the type of stuff I want to share with you here in the Family Office Club, like gross revenue royalties, or doing more debt instruments, or just focusing on white space type structures like performance only fees with an escrow drip. If it's something that investors are asking for over and over, then other investors should consider using that. There's a reason why they're asking for it, the more sophisticated ones that are on stage every year at our events. And if you're raising capital, then listening to that very closely can allow you to really stand out. So people say, wow, I didn't know anything like that existed, or that's refreshing, or I've been looking for something just like that. And it's honestly what keeps my interest, because I know none of you are coming to our 30 live events per year. And I'm on the phone every day interviewing the investors and doing the virtual discussion panels every week now, and going to all 30 events. And I don't want to sit there and listen to something that I've heard a million times. You know, I get bored easily. And that's why we have 5, 6 people on the discussion panel. It's why the longest standalone talks at our events are 15 minutes. No one's out there talking for 45 minutes about economic policy or some trust structure terms that no one can understand. We keep it moving fast so that I don't get bored, and that's kind of a litmus test for not boring other people. But also I write all the questions for the discussion panels because I want to learn more, because the more I learn, the better I can serve my investors. And then I can pass on that advice to those that are raising capital and structuring deals. And that's why we help those on both sides of the fence, but only take the fees from the investors when they invest in the deals that we put together. So it is 1:48, I guess 3 minutes late there, but we're going to open it up for questions. Those of you who missed the first section, there's a couple hundred of you that came in 5-10 minutes late. Family Office Club has been around since 2007, 2,000 registered investors. We have 450 investor mandates within the portal. We interview one new investor every business day and upload that to the portal. And we do a virtual investor panel every week and upload that to the portal as well. On the screen here, if you're watching visually, you can see also some of the other resources we have are 42 niche investor databases at familyofficedatabases.com. We also have well over 130 proven capital raising strategies. We talked about 1 or maybe 2 of those 130 just here on the webinar, but you can really dig into those if you become a member. And every quarter, we'll give you 20 pieces of feedback on all your marketing materials. It's $14.50 right now to be a member for a year, and that locks you in for a year, even when our live events start again. When our live events start again, we'll ratchet it up to $19.97 and $24.50 back where it was before. Or we have a monthly option at $2.99 a month with no long-term commitments needed. It's kind of like a Netflix of investment firms and investment organizations. So if you want to become a member, go to familyoffices.com to join. And now I'm going to take Q&A here. So feel free to submit your questions, and I'll be scrolling down from top to bottom here as fast as I can. Is preferred return used for equity investments in LLC partnerships also? Usually it's not, but it can be. One thing I've learned is that if you don't ask as an investor, you don't know, and I think you have way more leverage than you know you have. Many times investors will say, oh, well, we want them motivated. They're like, they might say something like, they're providing 25% returns every year. So let's have this hurdle at 15% or 20, and then we can share 50-50 in fees. And I say, well, if they stop providing you that return, you're going to pull your money and go somewhere else. It's binary. So why give away half your profits? They'd probably be happy with 30% of the profits, or maybe even 25%. And if we can cut those fees in half, it's going to dramatically change the returns of the investor. That's just one example of negotiating terms, as an investor, and the type of leverage you can have. For GP/LP fees, is it reasonable to charge a 1% management fee on the capital raised? I mean, I don't know who you are, what you do, what your team is, what the cost of your strategy is it higher than your competitors' costs. I don't know if you have a 20-year track record in a 20-person team, or if you started this firm yesterday. So it's hard to answer in a vacuum. All else equal, I would go for 50 basis points instead of 1%, or 75 basis points, or just track fees. Even if it's a prorated percentage of your payroll and all of your true overhead, but you have a spreadsheet that shows that transparent tracking, that you're not making a dime off of that management fee. So you're going to charge back the exact amount, which usually comes out to 42 basis points or whatever it comes out to for your firm. I would lean that way rather than charging the management fee if you can. Does pitching pro forma projections run into problems with regulators? Yeah, it does if you're not careful. For sure it does. So I would be very careful on borrowing track records from other firms. I would never promise the moon, because people know that those who promise way too much either don't know what they're doing, or they're a fraud, or they don't respect risk. Like, I had already watched Game of Thrones, but my wife hadn't. So we started watching the first season. And at one point, Greyjoy asked one of the other lords, he said, "Are you scared?" And he said, "Yes." And he said, "Good, that means you're not stupid." And investors want you to be a little bit scared for their money. And they want you, like Mr. Wonderful would say, "Don't kill my money." He wants his money to come back to him. So if you're promising the world, it's not taking into consideration that pricing might not be right, might have to replace a key salesperson. A virus might come out of nowhere and surprise the world and lock us all in our homes. So it's always better to over-deliver and under-promise. And if people think that you're over-promising, they're going to think you're taking a lot of risk, or you don't know what you're doing, or you don't respect risk. Please explain the pref structure of a LPGP deal. So real quick, that is basically just saying the investor is going to get their 7 or 8% return typically. Sometimes people go high, sometimes they're as low as 5 to 6% before the profit split calculation begins. I will mention that the highest preferred return I've ever heard usually is in that 12 to 15% return, and some people will do a profit split of 75-25 after a 7% pref, but then after a 12 or 15% pref, it'll go up to 40-60 or even 50-50 if they get a home run. The highest I've ever heard is a 30% preferred return. At that return, the investor gets 30% and then nothing after that, or they have the option of a normal fee structure. The investor chose a 30% preferred return. The investment in that case returned 150%, and the investor was frustrated because they lost out on most of that return, and they came back to that investment management firm and invested with them several times more. That's pretty unique. I wouldn't recommend doing a 30% preferred return. It'd have to be in a relatively high risk area, and it could communicate the wrong thing to investors, but I just want to show some extreme examples. Richard, I'm raising a fund and decided to not charge a management fee and split 15%, 85%. Well, the first part of that, I know it's not your question on should you raise a fund, but I would question whether you should. I know a lot of people who have raised 100 million, 200 million, and now they're struggling at deal by deal. And now they're starting a fund. It's half born because their past investors come into the fund, but no new investors want to. They don't know them yet. They haven't invested with them deal by deal. They haven't known them for years. They don't want to be in a blind pool vehicle. They want to know exactly what their money's going into. And so if you don't have to do a fund, I wouldn't do one, or I'd have a fund plus a deal by deal option, even if you make it so they could go deal by deal for 1 to 3 deals, and then they have to come into the fund. They either like you or not after 3 deals and trust you or not. But I would never just do a fund. Many people say, oh, well, we have to because we can't run around chasing the investors with 6 weeks to close. It's like, well, okay, well, you're trading one headache of running around chasing the investors, but showing them something they actually want versus chasing investors that most people don't want to fund. Once you get to institutional groups, multifamily offices that are billion plus, endowments, pension funds, insurance companies, some of those mostly only invest in funds. But in private investor world, it's harder to sell a fund than a direct investment. People do it all the time. People raise 100 million for their funds all day long. But if you have a choice, I think it's easier not to. 15% to 85% on the profit split is very generous of you, especially, I mean, maybe there's no preferred return and maybe that's why you're having that level of split. Most people would take a little bit more profits, so you have a healthier business for yourself, like 20% or 25%. You know, that said, you know, just so you guys know that the advice I'm giving here is advice I actually use, not just to fill a PowerPoint slide. You know, I've done the gross revenue royalty deals 5 times. I'm showing a debt investment that's like what I talked about. It can grow equity quick to one of my investors right now. And also for privateequity.com and the work we do with investors, we structure our deals so it's all back end. We don't charge them anything to onboard. We don't charge them consulting fees to start or formalize their family office. We use that to get to know them, define their strike zone. And then we're just charging a usually 10 to 15% profit share in the back end, or for 100 million plus families, you know, a 5% profit share on the back end. It just depends on the sophistication of the investor and what size of an investment they're making. But it's all back end. And I did that because I've been on stage, you know, we've hosted 140 live events. I've spoken at 250, and I hear what the investors are complaining about. And I know it's going to make my life easier having something more aligned. So I just wanted to share that so you guys know that it's genuine. This is really what I think is the best thing you should be doing. Waterfalling GP-LP split 80-20, 35-65, 50-50 with benchmarks. A thought, 50-50 is pretty aggressive. Some investors will push back on you. If you're going to offer 50-50, I'd have your retail fee schedule, and then I'd have the fee schedule for if they invest over 250, or if they invest over $500,000, then I'd have the more sophisticated splits there, so that the max you're taking is 33% or 35% for someone who's investing over a certain dollar amount, because taking 50-50 or even 35-65, you know, can be tough with some hard negotiating family offices. If you raise capital for a real estate firm, what is the common fee you can charge for raising capital? Let's see here. So the common fee. So basically for a private equity deal, many times people are charging 1% to 2% of the amount raised. If it's a small deal and you're raising 3 million or less, you might be charging 3% or 5%, or a real tough deal with a short timeline, people get paid as much as 5 to 7%. I would look at the Lehman formula. You can look that up like on Investopedia or Wikipedia and look at the Lehman formula and see how that ratchets up based on the size of the deal. If you're raising capital for an evergreen SMA hedge fund, the industry best practice would be to try to negotiate 20% of fees in perpetuity. People will try to push back and say, no, we want to cut you off at 5 or 7 years, or we want to only pay you this percent, but I would try to get 20% perpetuity if it's an ongoing investment vehicle or investment fund. And we brought in 160 million in assets last year to wealth advisory partners, because we don't do traditional wealth management, but we know some of the best in class groups out there. We help with the direct investment component and starting family offices. And on that side, when you're bringing those accounts to a wealth advisor, it can be anywhere from 10% to 33% in perpetuity is typically the market. Some want to put a shelf on that, but obviously you never want to. Let's see what other questions we have coming in here. Do you have a mind map, a grid of different pros and cons of these structures? Daniel, we don't yet. Maybe we should. Maybe we should have an infographic on this or some sort of summary document. You know, if anyone else would appreciate that, just put a little comment in the Q&A section to let me know. It wouldn't be that hard for our team to put that together if it would add value and kind of sum up this whole webinar. Another question here. Are you speaking to independent sponsors versus funds on the fees and the carry? I think it's general advice, whether you're a sponsor, a fund, or someone who has an operating business. Knowing these different structures can just allow you to be more fluid. Maybe only once in the next 10 years, you'll get a chance to use one of the strategies we talk about here. Maybe you'll never get to, but you'll be on the board of another firm, or you'll be able to help your brother-in-law navigate something. But the main point is that many deals come to a stop because of a bad valuation, or someone's afraid of the risk, or someone doesn't like being on the equity side and not getting dividends. And if you just use a different structure, if the problem is not the team and the value add that they have, then a different structure can many times solve that problem. Especially for sophisticated investors who just really don't want to pay more than X times EBITDA for a company or overpay for an asset, because they're so sophisticated, they see really great deal flow and they know how to add value to deals. And many times they don't, they were extra sensitive, not overpaying. All right, let's see here. Who would be the managing member in a co-GP structure? wouldn't multiple managers be cumbersome? The GP is typically the managing member. Yeah, there could be multiple managing members. There might be different responsibilities by different managing members. So that would all have to be defined in the docs. It could be cumbersome, but it might be that cumbersomeness might be less painful than not getting the deal done. So it's just a trade-off of, if you need it to get the deal done, then it might be worth doing. There are ways to reward people, maybe with giving them no fees and let them invest. Just have them be an LP. You don't charge them any fees, or you charge them a very low fee, or just give them preferred access, for the next 10 years on any deals you do at reduced fees. There's other ways to reward people besides going through the complexity of co-GP, and less complex, the better, I think. There's a question about how many fundraisers, operators deliver monthly as opposed to quarterly. I'm not sure what you mean by deliver monthly or quarterly, but I would say that all else equal, whether you're talking about reporting to investors or kicking out cash flow distributions, monthly is more appreciated. It takes more work. But again, if the real bottleneck is earning the trust of investors and having the most aligned model, then whatever work you can do to make that work, then it's better for you to do that. The same with investors. You only have so much time and so much money to put to work. So the more they align the structure, the more that money is going to come back to you to reinvest faster. Okay, here's another question here. Which is the best real estate strategy for cross-border deals? For cross-border deals, I would just focus only on investors local to you or who come from that country. So maybe they're of Indian descent. We had a hedge fund group that was in the Family Office Club. I think they're still a member. And he had raised capital through a CPA. And I said, oh, that's interesting. He's like, yeah, in our state, we can compensate CPAs for referring investors. And I said, well, that's great. It's a good strategy. And he was of Indian descent, and his investments were not focused on the country of India. But he said, and I said, well, just out of curiosity, is your CPA of Indian descent? He said, yeah, he is. And I said, well, how many of your investors are of Indian descent as well that you found directly or through your CPA? And he said, yeah, about 80% of them. And so I gave him the strategy of going through his state and going through all the registered CPAs and having an intern or someone in his family highlight all the names that were obvious Indian last names, and reaching out to the other 37 Indian CPAs that were in the state of Illinois. And if you're investing in a strategy related to a cross-border deal, going to investors local to the deal, local to you, or have knowledge of that country is the low-hanging fruit, or people who know your industry super well. They invest in self-storage all day long. They invest in consumer products all day long. And that way they're going to be able to get their arms around the deal most easily. Related to the above, by principles, it sounds like you're talking about GPs, sponsors. Can these include lead family offices or just people like you? Sounds like you're talking about intermediaries. So I'm not exactly sure what your question was. This was from someone anonymous. But I think these strategies are meant to be presented in a way today that can be used by investors or someone raising capital, who's a company or a sponsor vehicle, because at different times you need to take a different tool out of your toolbox versus just going around and having one offering. And many times you'll come into a room and someone will say, like, hey, here's my 2 and 20 term sheet. And they'll say, oh, well, can we structure this as debt? And if you just don't miss a beat, you say, yes, we have a debt structure. Here's our debt structure. And you pull that one pager out, or you have that structure in your mind. I saw this on a deal negotiation recently where somebody was asking for 30% equity in the company, and then the person turned it around and was able to renegotiate it as venture debt, and they got the deal done smoothly without missing a beat. And I thought that was excellent. You usually don't see that. All right, here's another question. What was the last one you did not have a slide for? I couldn't hear it because you went so fast. Yeah, sorry, that was an equity bump strategy. I don't know what else to call it. I'll come up with a better name by the next time I present on this. But basically, they're putting their own equity in for, say, 10% of the deal. Before they syndicate it to other investors, they then raise the price per share on the overall deal before they syndicate it. So their equity of 10% becomes 14% or 16%. Then they syndicate that deal. So they're getting paid an equity bump at the front, no fees in the middle, no management fees, no back-end performance fee, no carry. Investors say, why don't you charge a carry? Everyone on planet Earth charges us a carry. And they say, well, we don't want to stop raising 100 million plus a year. This is different than the other firm I mentioned, who said something similar about their $25,000 minimum investment level. And this group has 2 billion in assets. When I met them, they were at 400 million in assets. So it's just an example of something. That's not the only reason why they've grown. They have a unique strategy, they have a good quality team, but it's something that makes people lean forward and is just different. What is an equity warrant as it relates to gross revenue royalties? An equity warrant is saying that you have the right to acquire equity in the company by a certain time or when a certain action happens. So I usually try to structure an equity warrant at the exit. I haven't done 100 of these, I've done 5. I'm not the end-all expert on it, but I've spoke with 3 different lawyers who have helped me with crafting the agreements on it. And essentially the equity warrant is not usually taxable. You have to check with tax experts on that. It's not usually taxable. Well, equity typically is a taxable thing if someone gives you equity in something versus an equity warrant, because until you activate the warrant, it doesn't have value. So at the exit of Better Bath, Better Body, the bath salt company, which, that the Amazon-based company I referred to earlier, if they had a sale, then I get a percentage of that sales price because the warrant is activated at the exit. Most warrants expire on a certain time, and they just give you a certain valuation access to a company of say, okay, well, you can invest to the gross revenue royalty, but we're just going to give you that 1.5 million valuation. You can invest another 200,000 at any time in the next 7 years at that same valuation. So then 5 years later, when the company's doing 5 million a year in revenue, you could activate that, acquire your equity at that time, and start getting your equity dividends. There's all different types, and we can do a whole webinar just on equity warrants. Do you see all the cashback waterfall structure being used? Investors getting all their investment before a sponsor getting paid? Yes, I do see that quite often. Under promise and overachieve, how low should you go to still attract investors? Well, you have to have a real business still, of course, so it depends. I mean, I'm able to go pretty low on our performance fees with Family Office Club because we have our operating business, producing 4 or 5 million a year. And then we have the, the performance fee part we do with investors, so we can pay the bills, so we can go lower to build momentum. So it's really a sliding scale of how much momentum do you need to build and how much can you afford not to charge, and how aggressive do you want to be on being handsomely rewarded when things go really well. But the more aligned you can make it and the more you can get momentum earlier on, the better. You can keep your costs low and keep lean, because a lot of people just never get up to momentum and they find it a struggle and they find it very difficult. So that's a lot of, I'd really encourage, if you enjoyed this webinar, to go to familyoffices.com, join in the membership. If you don't love it your first month, you can just leave the membership, and check out our full day workshops. Like just our workshop called Capital Raising Catalyst will provide you 10 times more value than you got here today. Our workshop on investor influence, our investment pitch prep workshop, we go through much more in-depth strategies. I have to blow through, I just had 22 slides here. And so in 45 minutes, we can't cover that much. Just in the workshops, there are 27 hours worth of content that's at the same speed, the same level that you heard here today that you can get by becoming a member. So I'd really encourage you to go deeper there if you enjoyed the content here today. And we help investors, if you're a registered investor with us on privateequity.com, we'll help you just navigate your investments as a client. What about performance fees and fund to funds? If you can negotiate in a fund to fund, negotiate down the fees in the fund that you're actually investing through and negotiate that down, then it makes your performance fee not look as high. So let's say that you're usually investing in 2 and 20 hedge funds, and your fee is usually, let's say 1 and 10. Well, you can go to the hedge fund and say, hey, I need you to carve down your fees and only charge 12% or 10%, and you still get your management fee. And then so the total picture is not much higher than they would normally have to pay. And if it does have to be higher, I'd make the back end higher if you can. And you could go to the hedge fund and say, hey, we have to eat too. So we need 75 basis points. So 1.25 is the most that our investors can pay you. And on the performance fee side, we want to split that in half with you for the capital raised. Hedge funds and fund managers in general, it's been brutal raising capital. So you have a ton of leverage with them if you can actually get that capital raised. There's a couple of very technical tax questions here. And not only do I have like 20 more questions to try to speed through, but I just am not the global expert on the exact numbers in the tax code. And I don't want to steer anyone wrong on bonus depreciation or recapturing of depreciation, or how to have accelerated depreciation on cost segregation or opportunity zones, et cetera. I can definitely help point you to the right experts, if you contact us, but I don't want to answer something live that's not really a good answer. The best way to raise money on a deal-by-deal basis to invest alongside an institutional fund. A lot of institutions won't conduct due diligence on something unless they've already invested in their fund. Some are exceptions. Some pension funds, some institutional groups are, 5 or 10% are very innovative, but most want to go into a fund and then co-invest with those individuals. So I think that's important to know. But if you can get an institutional group to meet with you face-to-face enough to really like your strategy and want to work with you, there's a few different ways. I know that one hedge fund group, what they do is they have their hedge fund with 20 different investments going at a time, but they'll bring their best of the idea of the quarter to other hedge funds or to institutions and say, if you want to put on this trade and sign this non-circumvent, we'll send you our 7-page brief and our report. This is our best of the best idea. But when you invest in this, we're going to take 10% a carry, 10% profits on that deal on the back end. And that way they get to take that person's best idea, but they also get paid for that. And it's a way to turn what traditionally was only a fund industry into something where it's really a direct investment for the investors. I think that was pretty unique. Have you worked with SPAC companies looking for acquisitions in healthcare? I have. This is from somebody anonymous. If you are a SPAC company, then let me know. If you're in the healthcare space, reply to the thank you email here. We see a lot of healthcare related deal flow. One of the 42 niche databases on familyofficedatabases.com is a healthcare investor database. We have an energy investor database. We have technology, fintech, cannabis, angel investor, single family offices, etc., wealth management firms. Have you seen groups do quarterly dividends from non-real estate private equity, a comparable or superior cash flow to debt, but uncapped upside with long-term gains? Yes, I have. I've seen one do a 9% return with warrants long-term, and I think that's a great model. I think anything below a 7 or 8% return just is so boring to people on the income side, it kind of loses their interest. But when you get to 9%, it gets their interest more, and 10% or above is really where the needle starts moving on getting high interest, I think. Got several questions here on what our members invest in pre-IPO or opportunity zones or fintech or technology. Well, we have 2,000 plus members that made their money in all different industries. We're not an investor club only for fintech or only for one little niche. So we also have databases with over 20,000 investors in those 42 niche databases. So whatever you ask, the answer is going to be yes, but it's a percentage of the investors that are in the portal doing the mandate interviews are going to be a lead. A percentage of the investors in the databases, we might have a niche database related to your space. But most importantly, and people get this completely backwards, I should have said this in the beginning of the webinar, there's only 600 of you on out of the 1,000 that we capped out at. One of the most important things is that a lot of people come to capital raising and they think it's a game of getting introductions. Like, hey, Richard, get me 2 fish. Who are the 2 people in this room? You know them all. Point me to them. You know who likes self-storage. You know who likes consumer products. And you can just make this so much easier for me. And it's almost similar to someone, like, it's very helpful to get a database. If you don't know who to contact, it's hard to send direct mail or book a meeting, of course. But they get the emphasis wrong in that they think that the golden trail is to get a lead or 2 from me, when really it's like the value that's 100 times greater is me showing you how I attracted 2,000 investors to register with us. We get 100 million plus net worth family cold calling us or emailing us once every week to 10 days. We built up 81 investors registered with us in privateequity.com in 1 quarter. And for the last 13 years, we've attracted and built up one of the largest ultra wealthy investor organizations. And I've had to listen to 200 investors on stage every year for the past decade running our events. And I've talked to and trained many capital raisers through our 50 live workshops that are full-day workshops on raising capital. So I know what people are doing that doesn't work. I know what people are doing that's working very, very well. And that's the stuff we like to share and prevent you from doing the bad stuff. And so the real value of Family Office Club is you'll get some leads. You can get some access to some databases. You get your materials improved, but getting your positioning excellent and getting it so that you can know how to fish better, not just someone handing you 2 fish, but teaching you how to cook bread and how to make the bread and prepare the bread and, nurture the fish and build a relationship and add genuine value first and position yourself like a grizzly bear so the fish are jumping towards you versus splashing around on the side of a lake trying to find one fish that's flying by 100 miles per hour. You want those fish coming straight at you and jumping in your mouth. No offense to any investors here that are listening. It's not about anything violent against investors. It's about wanting to attract them so they know exactly what you do. And all the investors at our events say that they want to know what you do in 15 seconds, in 1 sentence. They don't want to waste their time. They want to read an essay just figuring out if you're relevant on planet Earth to them or not. So they want you to have this information. That's why they speak at our events. So out of all the investors, like the 75 investors we had on stage at our event in December, the several hundred we had on stage last year, none of them were paid to speak. Kevin Harrington, a shark from Shark Tank, Grant Cardone, Mitzi Perdue, many billion-dollar-plus family offices all spoke at our events because they want to get access to deal flow. They want to get access to you as a participant here and get access to peers for the investors here listening and learn about new structures and strategies and be part of that community. It's a back and forth community, and that's why they come, to get deals done. They're not coming because they were a former general and we don't have a band come and play in the evening. You know, I'm not that fun of a person. We're just focused on getting investors on stage, saying what they want to invest in, making it functional. And, you know, that's how our investor club operates. And I should have mentioned that at the beginning of the webinar. But that emphasis on just getting a lead or two is the complete opposite emphasis of what I think you should have, because we can teach you how to fish a whole lot better and just nurture those leads and attract them more efficiently. And that's good for everybody. All right, do you also raise capital for businesses outside of the US? Well, first of all, we don't raise capital technically for anything. We help people raising capital with advice and workshops and databases and pitch deck reviews. We help people allocate capital. So our investors, we're helping them find the best of the best deals from the 40, 50,000 people a year that we're interacting with. And we see several thousand pitch decks and pitch teasers per year. And we help bring the best of the best, or the ones that are very hyper-specific, to our investors. So my healthcare client who invested in the bath salt deal, they wanted consumer product deals related to healthcare or real estate lending deals. And so we've brought them those two types of deals. Okay, there's a few more questions and then we're gonna be out of time here. How often are investors participating in SBA deals? Not too often in my experience, but you know, everyone should be considering SBA, especially right now of all times. But in general, it's a good option to be considering. One comment here about the infographic, I think would be useful because there's a lot of information to digest. We always want to cover more than less, but I know we do move very quickly. Some of the stuff you have to think over and apply to kind of learn how to use some of these structures. Here's another question. As a new company, would offering 51%, 49% to the investor and company and maintaining the company name be a better option than the opposite, 51 versus 49? Well, I would try to structure something where you're not giving away half your company from the beginning. The more you can preserve equity, the more that you're going to like me 3 years from now and hopefully come back to be a family office club member. So I would try to get something running that's very lean, improve the model and get customers in. I know for many concepts it's not possible. It might be very capital intensive, but you have to have equity left to incentivize executive teams later, to bring on other investors. And typically you don't want a CEO having less than 25 or 33% equity. So I understand that they might want control, but is it your company? Is it theirs? Is it your vision? Is it theirs? Are you dead in the water without them? So they have all the leverage in the world over you or not? I would just consider those things before giving away half of your company up front. Victor's question about a JV development partner. I'm happy to talk to you about that. Victor, if you want to reply to this email, we can look into that teaser deal and just see if there'd be a way to help out on that. Another question, what kind of revision have commercial real estate investor family offices had in their hurdle rates in light of the coronavirus? Or is that in process as we speak? For many, it's in process. Many people have hit the pause button a bit, but if you're short on getting capital to a deal and you have to close still in a few days, sometimes investors will come in and for reduced terms, they might help step in on that deal. In terms of your exact question on desired hurdle rates, I think that if the deal isn't pristine and very low risk and kind of an anomaly deal, people are going to be very cautious right now. Everyone's expecting, if you're listening to this in real time, for April to be a pretty brutal month. So I think many are going to be waiting to see how May 1st, May 15th go before pulling the trigger on a lot. So it has to be someone that you already have a lot of trust with, hyper local to the asset, or they understand the asset class very, very well, or you're just not going to make a ton of progress, I believe. Is it better to file Regulation D for a small $2 to $5 million offering? I don't want to comment on that because if you do it wrong and you get banned or suspended or fined or sent to jail, I don't want to be the person you point to. But I will point out one thing is that many people don't know there's a 506C registration you can do for the SEC if you're in the US, which allows you to talk more publicly about investments. So you can put it on a billboard or in a magazine and you still have to track that accredited investors are coming in and keep that documentation on hand for a long time. But I would just look into 506C and ask your attorney if you have 506C in place to allow you to more publicly speak about what you're doing. Would we have access to you, or do you have a broker-dealer network we can have access to access deal by deal for a fee? I know some broker-dealers that are highly successful out there. We don't often refer people out. We don't do that as a business. We're RIA licensed, not BD myself, because we don't do any brokering of deals really. We're just helping our investors allocate. What do you think of GP-LP structure, 80-20, 2 times return and then 50-50 to a 3 times return and then 20-80? I would never flip it so you get 80% of the profits. The most aggressive I'd ever go is 50-50, and after a 2 times return, taking half of the profits, depending on how much leverage you have and how fast you're raising capital. If you want to raise capital faster, I'd maybe do 33, and then after you're raising capital, very nicely do the 50-50. But if you've already doubled someone's money and it's a short duration deal, or you have a good team, then you might be able to do that. It might go all right. Is there a typical structure for real estate development deal? Purchase the land, now looking for debt and some additional equity. Many people have the preferred return with the hurdle, so the 8% preferred return with the hurdle. I would say that construction fees are typical in real estate development deals, and sometimes construction financing fees, because it can be more expensive than normal financing. So, you have to take everything I've said today about performance fees with interpreting that for your situation. Like, for example, in construction, or I know one group that does what other firms do in 5 years, they do it in 2.5 years. So they need to charge double fees, and some investors balk at that, but it's just their model. What's your opinion about the fundraising market during the COVID crisis? Is someone effectively raising capital? Yes, I know some people that are effectively raising capital and are closing deals, but I think it's in companies that are already doing well and they're doing even better now that the virus is here. There's only a few of those companies. Companies that have not been affected and they're pretty stable. So now investors like that even more, but they might be timid on the amount of money going in because they don't know how bad they're going to get hurt on the other side. Strategies that are not related to the stock market or real estate at all, like life settlements, is one idea I've been talking to some of our investors about. But again, I go back to, it has to be ones that you can meet with very easily in person, always invest in your space, or they know you very well already, because it's not going to be easier right now. But one thing you could double down on right now is creating content for your niche investor type. You could also double down on the strategy of, basically redesigning how you position. How do you be the grizzly bear at the waterfall to attract investors? How do you get your one-liner defined? Maybe take the time to go through one of our workshops every 2 days. And I guarantee you're going to have 30, 50 different action items, and you're going to be busy for the next 6 months trying to implement even a fourth of the ideas that we give you. In one of our workshops, whether you come live or watch it online, we're trying to give you 35 strategies within one workshop. So it's like a food buffet, and you're not expected to eat everything. You just pick and choose what's practical, what you can implement right now. All right, we're almost done with the questions here. I know I haven't been able to answer every question. If you wrote this huge paragraph, I just don't want to bore everyone by staring at the screen here while I read it. So I'm answering the short ones. Give a quick reference guide on all the deal structures. We're going to put together an infographic, at some point and send that out. We can probably get that done over the next 2 weeks. What are the most interesting debt structures for real estate projects? Most interesting one I've seen is someone who's buying Midwest properties and paying investors an 8% debt note backed by the properties, and he grew a $100 million portfolio, paid off all the debt notes over 5 to 7 years, and then he's worth 100 million plus. That's the most simple one that I've seen. You just have to watch that the properties can, in a worst case scenario, help you meet those debt obligations. Otherwise, you're putting yourself under stress and losing the assets and making investors upset. You'll be back in Dallas anytime soon once our events start up. As soon as we're allowed to, and the CDC isn't saying don't do events, we're going to start hosting small events and space people out by 3 to 6 feet, and take the logical approach most other event companies would take. Let's see here. Have you done any deals? I've got a couple questions about countries. We've looked at deals in many different countries. US, London, and Singapore is where we're most active, but we have investors of descent in many different areas around the world. Can you help first-time fund managers raise $100 million? We definitely can be a huge help to first-time fund managers or investment professionals. We can help you save months of frustration in paying retainers to people that are going to maybe take your fees up front and not do much for you. And what we charge is ridiculously cheap for even, let's say you put together a fund structure, that probably costs you $15,000 to $25,000. Our annual fee is $14.50 right now. As soon as live events start up, we'll go back up to $19.97 and $24.50. And our normal fee is $24.50 for the annual membership as of now. And that'll be just going up over time as we want to have a higher quality group. But we're talking about for 1/10 of what you would pay a lawyer just to structure your deal. We're going to give you 130 strategies, review your materials, give you exposure to daily investor mandates, 450 recorded investor mandates. It's a crazy value compared to some legal docs. No offense to any lawyers on here, but legal docs are important and needed, but they're very expensive for what you get too. All right, maybe virtual networking events, are those feasible? Yes, we're doing virtual investor discussion panels every week for our members. We're recording those and we'll be rolling those out in the live format here over the next week and not just recording them and adding them to the portal. Are you doing more webinars like this? Yes, we are. Some of our webinars will be exclusive to members only. So you'd have to join at familyoffices.com to see all of them, but we've got 36 of them recorded. And we plan to do one webinar generally every week, doing a live webinar. So I'm glad that you enjoyed the webinar, Samir. And yes, we will be recording this and distributing it. So we got through all the questions. I know I skipped some of you who wrote a little paragraph, but maybe some of those people left already. So thank you for everyone's attention. If you have any questions on how to work with us or how to benefit from our resources, you can check out our free book on capital raising at capitalraising.com. Go to familyoffices.com and look at the membership options that are in there. I would encourage you to do the annual membership before that goes back up because we're usually hosting 30 live events a year. And now we're just doing a weekly virtual discussion panel event and those daily mandate interviews. If you have questions on databases, that'd be through Daphne at familyofficedatabases.com. You can go there and ask him questions. If you're a member and you have questions on navigating the portal, which we just redesigned and gave it a big facelift on the UI, you can talk to Jennifer. That's Jennifer at familyoffices.com. And if you want to learn more about PitchDecks and our investor relations marketing agency, that's Andres. It's Andres at pitchdecks.com, or actually Andres at familyoffices.com would be easier. And then finally, if you're an investor and you stayed on the webinar this long, then please go to privateequity.com. You can become an investor client of ours in just 4 or 5 minutes. We can help you navigate formalizing your family office and getting access to our best deals. So thanks again for everyone's attention, and I hope to see you on our next webinar, which will be next week. Sorry for the confusing Zoom notifications, but hopefully between us and Zoom, we'll get that right the next time. Take care.